we are extremely delighted to have with us Professor Tomoe from Brunel, and also her co-author. So let me take the opportunity to welcome Tomoe. Tomoe is not a stranger to many people. She has dominated the literature for quite some years now, is highly specialized in the area of flow of funds. And this is one of the areas we cover. I was reminding Tomoe just now that we met last time at MIT in the States when one of the professors at MIT, Robert Townsend, convened a group around the world. It was just a small group, about 15 people around the world, who specialize in the area of flow of funds and who are published. And so it happened that Tomoe, myself, and Chris Green were present at that meeting. So her research is grounded in flow of funds policy analysis and affecting economic development, banking in particular. And she's one of the most competent technical experts in modeling complex systems that include flow of funds and using all types of data. She's spoken at MIT, central banks, Ministry of Finance in some African countries, and has started recompiling a flow of funds metrics based on IMF database for developing countries. She has been prolific over the years, and it has been my pleasure to know her. Prolific in many highly ranked journals, including the Journal of Corporate Finance, Economica, the Journal of Banking and Finance, World Development, Economic Development and Change, Journal of Development Studies, European Journal of Finance. I could go on and on and on. But today, she focuses on an aspect of flow of funds. You see, flow of funds, you could have a dimension, look at this particular asset. And in this paper, she's looking at capital inflows and posing a very important question on what effect does capital inflow pose on the imports of capital goods in developing countries. So trying to track down that is a very important question to actually double question in the sense that you are looking at the impact of capital flows, but also you are looking at the nature of capital imports into developing countries. And the work is a thorough piece of work. So we actually feel grateful to have her present the work. But also in the nature of the Center for Global Finance Research Seminars, we invite all participants to be generous with comments and feedback about this work, given that it is work in progress. And like all seminars, it is a stage whereby the work can generate input, suggestions, questions, proposals, interrogation of the methodology used, the data, the conclusions, flagging up implications for policy analysis, all those aspects in the course of this seminar today. And the work is also done jointly with the Ali Mosey at the American, I hope I pronounced the word correctly, Ali Mosey at the American University of Sharjah, and Jan Fidmark at the University of Lille, and Khrushchev Gabriel also at the American University of Sharjah. That's a group, and Tomoe is a group player. She's very good at working with people across many dimensions in the world. She has done actually with me. I should say that right from the start. Tomoe and I have done some joint work in that particular area of interest. So Tomoe, it's a great pleasure. Please put your hands together and let's welcome Tomoe to the CF seminar today. Thank you. You have the floor.
Okay. Thanks very much for such a nice presentation of my profile and also this paper. And thanks very much for your kind invitation for me to present one of my papers in this seminar. And also thanks to the participants taking your time in this busy time attending my seminar presentation. Yes. Title is just I just close my video. Sorry,
Yeah.
because it works with my PC.
That's absolutely fine. Yeah.
Then I will open full screen of my PowerPoint. Okay.
Thank you.
Yeah. Yes, title is The Effect of Capital Inflows on the Imports of Capital Goods in Developing Countries. This paper, we just almost finished the first draft. So this is a great, good timing to present this paper today. And then as Victor mentioned, this is co-authored by 3 academics, and 2 of the academics, Ali Matsai and Kuslav, should be here. And although I'm presenting all the slides and everything today, taking maybe 45 minutes. I try not to take so long. Later, my co-author can join in a discussion. Right.
Yeah.
So I just want to give you a brief background of this paper as a preliminary in this slide. I just go through this slide. Incorporating advanced technology from wealthy or developed countries with a strong R&D, it can help firms in developing countries to improve their productivity. But importing and adapting foreign technology, which are quite expensive, so requires financial resources. Particularly for financially dependent sectors, limited access to external finance may be one of the reasons why they can't, some of the farmers, they can't afford import better technology in developing countries. However, then capital inflows, financial inflows from abroad, they may reduce credit constraint and increase investment resources. Against this background, we wish to investigate the extent to which capital inflows can assist financially dependent industries in developing countries to import more capital goods for growth opportunities. Lastly, maybe needless to say, but just a clarification, when we say capital goods in this paper, it refers to physical assets, such as machine and equipment to produce manufacturing products. Right. So, I start presenting with the introduction, followed by relevant literature to our research question in order to clarify contribution. Then I present econometrics model that is a linear model, and then data sources and data analysis. This is followed by presentation of empirical results. I start with a baseline result and then other additional analysis. Then conclusion, where I will highlight the key findings. Yes, introduction. There's a debate on the impact of international on the relationship between international financial integration and growth. And then in literature, there's some mixed evidence of the relationship. For example, it is argued while capital inflows facilitate productive investment and foreign technology import, but weak institutions or poor investment environment in a country, it may lead to resource misallocation and dampen growth. Such a mixed evidence is documented in a couple of papers. And also use of the heterogeneous samples in some studies, combining both industrialized and less developed economies. It may also this may be also the cause of the mixed evidence. Surely, developing countries, they are relatively capital scarce and labor rich, so they should benefit more from improved access to capital as compared with developed counterparts. So, because of the given mixed evidence, some studies have focused on the particular channel through which financial integration affects growth. Examples such as improvement in total factor productivity or increase in capital allocation efficiency. Now, taking this idea of a channel, we try to investigate the effect of the financial development on growth. So our aim and objectives is as follows. We examine one specific channel, that is imports of capital goods, and through which capital flows affect growth. We measure the impact of capital inflows on the ability of credit-constrained firms to import capital goods. More specifically, what we are going to do is we test whether industries that are more dependent on external finance, whether they import more capital goods if they are in countries which enjoy significant level of capital inflows. So, and we focus on developing countries because demand for external finance and capital goods are much higher than developed countries. And we use panel data set for 11 manufacturing sectors and in 57 developing countries over the period of 20 years. Literature. Relevant literature. The first type of relevant literature related to our research question is they examine whether imports of capital goods boost growth. And then typically they find foreign capital goods affect positively growth in developing countries. For example, it can improve the quality of capital stock and boost total factor productivity with the use of advanced technologies. Also, it is argued cost-effective technologies through the imports of capital goods, they can reduce the relative cost of investment, then increasing investment rates. So these collateral benefits of foreign capital goods, such as I said, allocation efficiency or total factor productivity, they could result in a high level of growth. And then there are a number of papers which find evidence of the growth enhancing effect of foreign capital goods. However, issue is, despite the potential benefits of import of capital goods, firms in developing countries may be constrained by a lack of access to credit in order to import capital goods. So the second type of relevant literature, they examine whether credit constraints reduce imports of capital goods. And then one paper find credit-constrained firms in developing countries they are less likely to invest in capital goods. Similarly, another paper find for India, that is, Indian firms with poor liquidity, they are less likely to import capital goods. On the other hand, the firms with a high level of liquidity, they import more capital goods. Also, the researcher Tybalt, Tybalt shows that firms in credit-constrained countries can import capital goods, but at an extra cost. So all has a negative impact by the credit constraints. So the next question, then foreign capital inflows, whether they mitigate the adverse impact of credit constraint on capital goods imports. That is the next question. Then we can look at third type of relevant literature, that is, they examine whether the capital inflows alleviate credit constraints. Actually, what they find is capital inflows can increase liquidity and facilitate risk diversification, reducing the cost of capital and then allowing firms to invest in more capital goods. And also, as a couple of papers find, foreign capital supplements insufficient domestic saving in financially deficient economies. And then by lowering the cost of borrowing, it allows investment to increase. Another positive effect is one of the paper find capital inflows transmit technological advances and facilitate knowledge spillovers across borders. And they found which can be, in particular, significant for among credit constrained industries. So 3 types of relevant literature putting together, it seems to indicate there is a close relationship between capital inflows and capital goods. So I just summarize in the next diagram. As I said, the first type of literature, they found imports of capital goods boost growth. Then second type of literature find lack of credit constraints reduce imports of capital goods. Then the third type of literature, they find capital inflows mitigate credit constraints. Then we can argue capital inflows should increase imports of capital goods and then boost growth. And there are relevant literature for this argument. That is a fourth type of literature, right? They examine a link between financial liberalization or integration and capital goods. So there are only 2 relevant studies in this relationship. One of the paper, that is Alfaro panel, they find countries that liberalize their capital markets acquire more advanced technology that is transferred from imported capital goods. And the other paper find evidence of the positive effect of international financial integration on growth through the capital stock quality. So these studies refer to development of financial markets, such as I said, liberalization or integration, but not rather than a specific measure. In this paper, we are referring foreign capital inflows. So, given these relevant literature, I can clarify our hypothesis is as follows. Industrial sectors that are financially more dependent will import more capital goods if they are located in countries that host more capital inflows. And the difference of our study from existing literature is we investigate one channel through which capital inflows affect economic growth, that is via the imports of capital goods. There's one study they used this imports of capital goods, but difference is we use de facto measures of capital inflows. But most previous study use so-called de jure measures of capital account openness and financial liberalization. By saying de jure, it refers to legal restriction or financial regulation on cross-border capital movements. And then it is pointed out collateral benefits of financial globalizations are more perceived through these de facto measures, such as capital inflows. And we focus on the manufacturing sector in developing countries because capital goods are usually the major component of the assets. And then further, we narrow down to take account of the degree of the external finance dependence across industries, so that our study, with our approach, we are able to examine more accurate view of the potential effects of foreign capital inflows. So these are the some our contribution. Then I can move on to the model specification. This is a linear regression, quite straightforward. Dependent variable, that is share of the imports of capital goods, goods to GDP. It varies with the sector, country, and year. Independent variable, EFD, that is a measure of the industry's dependency on external financing. It varies with the industry. Okay, and then CF, which is denotes capital inflows as percentage of GDP for country C in year T-1. We take the year T-1 to mitigate endogeneity issues. And then the coefficient of the interaction term, external finance dependence and capital inflows, there's an important coefficient which address our main research question. The coefficient, this measures the difference in the share of imports of capital goods in financially dependent sectors in countries with high or low foreign capital inflows. And if we find coefficient is positive and then statistically significant, then our hypothesis is supported. That is, financially vulnerable industries in countries with higher capital inflows import greater amount of capital goods. I just carry on this model specification. We use the most rigid fixed effects, DIC or dummy IC, which control for cross-industry and cross-country fixed effects, such as industrial policies in each country. And then dummy IT, which captures time variant and industry-specific factors, such as industrial R&D investment. And then dummy CT, which accounts for time variant and country-specific factors, such as political and legal environment. In the empirical section, I'm going to present a baseline result, and this will be followed by other analysis with endogeneity issues or instrument variable technique or additional analysis by decomposing the total capital inflows. So I will explain about these things as we go through the empirical section. So data source, as I mentioned, this is a three-dimensional panel data set, 11 manufacturing industries, 57 developing countries, sample period from 2000 to 2020. I just want to highlight just one of the key independent variable, that is a measure of the degree of external finance dependence of each industry. This data comes from one of the papers, Raven and Valencia. They constructed this data using US farm data. It is defined as a share of investment not financed by internal cash flows. Why US farm data? Because US financial markets are relatively frictionless and informative. So that industry characteristics based on US firms, they reflect technological characteristics rather than US specific industry. This data is initially advocated by Raja Zingeyo. This is a major paper, and then this data is often used in a finance literature in other topic. Right. Just a data analysis. This table shows average import of capital goods and external finance dependence across 11 manufacturing sectors. As I highlighted, the highest import of capital goods is found in machinery and equipment manufacturing sector. It has also quite high external finance dependence. I wanted to give you an idea. So it's nothing special. It's not surprising. Then this chart, which shows the average annual import of capital goods and capital inflows over the sample period. Blue line or capital inflows, red line, import of capital. As you can see, two lines are remarkably close in the pattern of movement. So it's more likely there's a close relationship between the two variables. And also this will give you some insight into the relationship of the two variables. Then next chart is a scatter plot in the space of import of capital goods and capital inflows for each country, where individual industries are divided into high external finance dependence and low external finance dependence industries. The benchmark is the median value of the external finance dependence. And then black dot, which is a high external finance dependence industries. Based on the observation of the black dot, we could draw an upward line. So, which implies a high level of import of capital goods seems to correspond with a high level of capital inflows for high external finance dependent industries. Whereas white dot, which indicates low external finance dependent industries, and then based on that white dot observation, we could draw a horizontal red line. As you can see, this red line, this indicates two variables are almost independent to each other. So given this chart, this would justify, perhaps partly justify, why we distinguish taking account of the degree of external finance dependence across industries. Right. So next slide. This is the one. We run a regression based on the linear model, which I have introduced. This is a baseline result. Just to remind you, dependent variable is an import of capital goods. And the regression 1 to regression 8, because this is a various dummies are specified, right? So as you can see, coefficient on the interaction term, that is external finance dependence and capital inflows, they are all positive and significant. This is a key finding and then support our hypothesis. So our hypothesis is those sectors that are more external finance dependent disproportionately increase capital goods imports if the sectors are in a country with more capital inflows. Yes, given, as I explained, based on the contribution, this is a novel finding. But if you look at the regression 9, 10, 11, where we split the sample period into pre, during, post subprime crisis, then we find that during the financial crisis, the coefficient of the interaction term is insignificant. This can be explained by the crisis, banking crisis, where the capital inflows is there's a severe disruption of the capital inflows at that time. So that's reflected as this insignificant coefficient. Then from this baseline, we control observable characteristics in order to address the omitted variable bias. Firstly, we specify market share and competition. Market share, because industries with more market share, they have a better position in importing capital goods, and also competition, because the level of competition may determine a sector's capital allocation. And we also specify durability of goods. That is a index of how much industry produce durable goods. And intangible asset, that is a ratio of intangible asset to fixed asset. So both are specified at the industry level. And then we look at domestic credit and also the financial regulations of capital openness, exchange rate regime, and tariff. They are all specified. And then GDP growth and inflation to take account of economic condition and stability. The result of the regression model is this table. Apologies, a bit smaller font, but at least you could see the a coefficient on the interaction term shows a positive and significant result. So this supports our baseline result and our hypothesis. Just the interesting result is this one: durability and intangibility, both are positive, significant. We expect durable goods should have a positive effect, but not the intangible asset. But given the positive, significant coefficient on the intangible asset, this result indicates strong intangible asset such as goodwill or brand recognition or the company reputation seems to promote or boost the sales and the production. Hence, this requires more capital goods. And then we conducted the so-called Oster omitted variable test, and then we find the baseline result is found to be robust to this omitted variable test. The next, we look at reverse causality. Because, for example, if external finance dependent sectors or countries, if they accrue more capital goods imports, then, for example, they will their sales revenue increase, then they may be the ones to play a dominant role in receiving more financial inflows from overseas, so that we exclude high financial dependent sectors, and also we exclude countries with a high share of financially dependence to GDP, and also we exclude countries with their capital inflows exceed the 10% of GDP. Yes, to take account of this concern of the reverse causality, right? Then result, yes, I don't need to say much. Anyway, as you can see, positive, significant on the coefficient of the interaction term. So supporting our baseline result and also hypothesis. Next, we look at instrument variable method. Instrument variable which used is the absolute distance between the country's policy position and that of G7, so-called ideal point difference. Smaller value of ideal point difference means smaller difference. That is, countries is more in agreement with G7 in terms of policy or political position. In this case, a dependent variable is slightly changed. We use the share of capital goods import from non-G7 because we assume such an instrument is correlated with capital inflows, but not the capital goods imports from non-G7. For example, if a country is politically close to the G7, that is the developing countries, democratic countries with a good legal structure, such as property right, then the economy seems to be deemed to be of a rather stable condition and then attract overseas investors. But if the countries such as authoritarian state with a dictatorship, with a poor legal system, regulation, and the laws of corruption, then economy is seen as unstable, then discouraging overseas investors. So this variable, instrument variable, should have an important implication to the capital inflows. Then next slide shows the empirical result. Again, we find positive significant effect on the coefficient on the interaction, again supporting our baseline result. We also conducted individual G7 countries. Then again, we have a consistent result, the positive significant. So we can say external finance dependent industries import more capital goods if they are in a country with high capital inflows. The further robustness test with the alternative variables. Dependent variable, initially it was a share of capital goods imposed to GDP, but instead of GDP, we take the total imports by that industry. And also we look at value added. And then also we look at alternative external financial dependence. There are a couple of papers. They also constructed this external finance dependence based on the US farm data, but it's a different sample period and a slightly different definition. So we all use all these data, these external finance dependence data. And then also we look at net capital flows instead of inflows for the robustness test. Despite of these alternative variables, again, we find positive significant effect of the capital inflows of capital goods, supporting our baseline result, and then our hypothesis is supported. So next, as an additional analysis, capital inflows, we decomposed into direct investment and portfolio investment and other debt. Other debt is such as bank deposit in a local bank by the non-resident. And then direct and portfolio investment, they are further decomposed into equity and debt. And among others, the property of the equity in direct investment, that is, overseas investors have a degree of managerial control, holding at least more than 10% of the ownership of the firm. So that's different from other type of capital inflows. And these data are taken from the balance of payment in the International Monetary Fund. Then result is shown in this table. Regression 1 to 3, that is direct investment. 1 is total, and then 2 is equity, and 3 is regression 3 is debt, and the portfolio investment is regression 4, 5, 6, and the other debt number 7. As you can see, we find a significant positive effect in equity and the other debt. And among between the two, equity size of the coefficient is much higher, larger than the coefficient in other debt. So we're just looking by focusing on this equity positive significant coefficient. Based on that, we can argue, we can interpret capital goods imports increase mainly with the capital inflows through the equity direct investment, so that the partial ownership of firms by the overseas equity investors, they have a valid effect in capital goods imports. This is contrasted with a result in portfolio investment cash capital inflows, because we don't find any significant coefficient. So there's no effect of capital inflows through the portfolio investment for the imports of capital goods. From this result, I have noted some implications in this slide. As I said, equity direct investment capital inflow has a valid effect on imports of capital goods. From there, we can argue that implication is shareholders with a management control may influence firms for the destination of capital inflows into more productive investment, such as capital goods for future growth opportunities. But since we don't find the effect of the capital inflows through the portfolio investment, then implication is portfolio investors may be often myopic, irrationally sell or buy shares in volatile developing countries, and then they may not be able to influence or they are indifferent to influence on firms' investment. Then this is a final empirical result where we looked at or examined the quality of imported capital goods. In this case, we slightly changed the dependent variable, that is the capital goods import from G7 to China. Why the G7 capital goods? Because the G7 the capital goods is the highest quality with a higher standard regulation. And why the China? Because China is in the past decades, they import heavily capital goods and achieved high growth, and they reached to the second largest economy and the largest developing economies. So this combination may provide some insight to the quality of imported capital goods. And then estimation result, as you can see, a coefficient on the interaction term that is positive, significant. The size of the coefficient is extremely high, 4.8. Although if we look at individual G7 countries, the result is slightly mixed. But looking at this 4.83, as I said, this is very large as compared with the baseline findings that was 0.01 or 0.02. So we can see much stronger relationship between the imports of capital goods from G7 and the capital inflows. So since the quality of capital goods from G7 is highest, the result implies increasing capital inflow is contributing to a higher quality of capital stock by importing more from G7 economies. So I think I can conclude now. I just highlight key findings from our empirical analysis. Our empirical data supports the following conjectures. The ability to acquire foreign capital goods is dependent on access to financial resources. Increase in a capital inflow is an enhancement in helping developing nations to alleviate credit restrictions and to increase investment resources. Consequently, industries that rely heavily on external finance benefit disproportionately from capital inflows by importing more capital goods. These results were found to be robust. And then, based on additional analysis, we find additional findings. That is, firstly, a relationship between capital inflows and capital goods imports breaks down during the period of global financial crisis. Secondly, imports of capital goods is mainly driven by capital inflows through the equity direct investment, but not from portfolio investment. And then lastly, host countries tend to import higher quality capital goods from G7 countries as the capital inflows increase. So I have to say thanks very much. Yes. As I said, there must be two co-authors of this paper must be present in this seminar, so they can join a discussion from now on.
Let's give a hand of applause to Tomoe for an excellent paper. This work is very strongly motivated. The whole globe, the world economy, the world financial system is going through a tough time of liquidity. There is indeed a huge liquidity squeeze, which was emphasized by the IMF Global Outlook, which was launched at SOAS last week, and also at ODI in London here. And the whole was about a lack of global liquidity, including capital inflows. So this takes up, this paper comes in at a very, very crucial time. It's contemporary and takes up an important issue. That in particular, developing countries have to keep on importing capital because they have to keep on the capital inflows to be able to generate capital imports to be able to support their growth. The story is very well told. The paper is strongly motivated. Very strong synthesis of the literature from literature 1, literature 2, literature 3, literature 4, with a kind of strong connection. This is how one can derive a plausible hypothesis from an existing literature. So very instructive there. And then you have very rich database that includes, industrial level, analysis, a huge data, huge group of countries. And then a completely thorough methodology that is able to go into the granular aspects of identifying the strong link between capital inflows and an increase in capital goods. In fact, the first chart was so instructive, and I was wondering, why is it that the two curves are not the same? What's the gap there? Where's the gap between capital inflows? And the gap has to be there because maybe there is some capital inflows that do not necessarily translate into capital goods, into imported capital goods. But still, we find a stronger emphasis as predicted. And what is more convincing is the robustness tests. In other words, showing that the findings of this work are not accidental, okay? That you have strong evidence. So there is a presence of evidence and also evidence of presence, okay? And so and so basically, sure, this is what we find. And even if you test it so much, allowing for other possible configurations, you still get the results. The results persist even when you test for alternative specifications and alternative empirical models. And that's very, very, very reassuring.
Thank you. Thank you.
And then you bring in this aspect of China, which is a good example of saying, under any condition, we look at, a story emerging global power and the link with, say, US, what happens? Still, the story is the same. Huge capital inflows, huge increase in imports, capital imports. And of course, that has implications for growth. Now, before I open up the floor for discussion, just allow me to make one or two a positive, I should say, positive comments on this work. And one of them is about the recent onslaught of the COVID-19 crisis that disrupted every major economic force and major financial flows. In fact, the experiment you did with the global financial crisis is very instructive. You find that during the global financial crisis, this relationship does not work. There was so much disruption. Data maybe doesn't permit at this time, but when data permits, it might be interesting to see how this relationship fared, if it persisted at all, if any insights can be obtained when we consider that phased approach, especially the breakout of the COVID-19 in March 2020, that's the global breakout of the COVID and then the subsequent lockdown. I would expect there would have been to be a great implication, which could be brought in here. And maybe that's an area that is to be explored by the extension of this work, if the data at the moment may be inadequate.
Yeah.
And then there is this important question of where you have the interaction between capital inflows and foreign exchange reserves. You have FXR, and they interpret it to be foreign exchange reserves. Okay, now, this is important for policymakers, because policymakers, if I was a central bank governor, I would be thinking that you stretch all the resources of the central bank and the country to ensure that the central bank is holding at least 3 months, 3 months import worth of foreign exchange reserves. You are trying to ensure that you have foreign exchange reserves to support at least 3 months, because if the central bank is unable to service or pay for any imports, including capital imports, within a period of 3 months, then the country is likely to declare that they are bankrupt. So central banks observe this, and the Bank for International Settlement keeps a tab on this to ensure that every central bank has a 3 months of imports. Now, the question at the back of my mind could be how we can interpret your results in view of this rigid rule by central banks. It may well be the case that countries which have huge excess reserves, in other words, they are not worried about 3 months, they can still meet capital goods and credit goods for even 6 months, for even 9 months, for even 12 months. Okay, maybe the resource-rich countries, in OPEC countries, the Middle East, maybe they are not worried about having those that they can meet any imports at any time. Now, so countries that have this excess foreign reserves, maybe capital flows to them is not a big issue, and they can still meet their imports of capital goods with time. I wonder what the story is, but maybe this is why when I looked at the coefficient, the interaction term between capital inflows and foreign exchange reserves, it was not significant. I was expecting to be positive, but maybe that's something, but there's something to look into. because it will have very important policy lessons for bank regulators and also for practitioners at central banks. But this study has great implications, especially for countries to open up to capital inflows, because that is the channel. This is what when you get a chance to go on BBC in London next to your university to make it. Countries have strong motivation to open up for capital inflows, because they can then boost their imports of capital goods and keep growth at momentum. Maybe it's a strategy for recovery. Yes, indeed, it's a strategy for recovery from lockdown and this crisis of liquidity. So thank you very much, Tomoe, and your co-authors. At this time, I will open up for discussion, but maybe it's fair to first pick the comments in the chat. There is a great comment from my colleague, Richard Alexander. Yes, this is very pertinent. The nature of a political regime, the nature of a democratic regime, the nature of the rule of law. These are important questions. Maybe I should give you a chance to ask the question if you are see around in the audience and you can articulate. But this is so important, because sometimes scholars of economics and finance will run away with the numbers, but we forget that each country has this system. Are they rule of law, or are they a complete democracy, or is it a fragile state? Okay, so please go ahead.
Thanks, Victor. I was interested in the fact that you were, when you were talking about the measure of how politically close or not is a particular country to the G7. You said so, and you equated, you equated the divide between, on the one hand, democratic, established, effectively global North states, and developing countries with authoritarian regimes, poor rule of law, and high levels of corruption. Now, of course, all 7 leaders of the G7 would be delighted with you for that, to put it in those terms. But I thought, well, those authoritarian, and you also said, and you said that these developing countries with authoritarian regimes, etc., tend not to attract the kind of foreign investment that the democratic global North does. Then I thought, well, is that actually true? Because China and India they're both authoritarian regimes. Okay, India may be slightly less so than China, insofar as India has at least semi-meaningful elections, but still, under Modi, pretty authoritarian, but attracts high levels of investment. And the main break on both has been, to what extent is the state willing to allow foreign investment? Both India and China have put brakes on that. So I thought, well, is the real divide between is the real opposite, not so much developing countries or authoritarian regimes, but countries that have authoritarian regimes that the West doesn't like. If you're Saudi Arabia or India, you have an authoritarian regime, but you're good friends with the West and everything's fine. If you're China or Zimbabwe, the West doesn't like you, or Iran, then you have an authoritarian regime and the West doesn't like you, and you struggle to attract investment. Now, of course, the 3 examples I've given are all very different economically, but you get the point. So I wondered whether and that particularly came to my mind because almost finished, a number of scholars have been talking about the impact of South Africa's getting closer to Russia? Will this make it more difficult for South Africa to get off the FATF grey list? So I wondered what you thought about that.
Yeah, yeah, thanks very much. It was really, actually, maybe the way I mentioned, maybe very simplified authoritarian democracy. As you said, exactly, yes, China, kind of but communist one-party system. But in the case of China, I think more to do with the growth opportunities much higher. So you may be right. Something I need to review some more detail of this data of this ideal point difference. Yes, it's a good opportunity. I will have a more in detail look at this data. Actually, this data came from, I think Ali, one of my co-authors. Ali, are you here? Are you some comment on this? Yeah. Yeah.
Or maybe Khosrow, if Khosrow,
yeah, I can comment on this.
Okay, go ahead.
Kusuraf, okay. One of another co-author, yes, another co-author, yes. Kusuraf, please.
We first take Kushiraf and then we take Ali. So first Kushiraf and then Ali. Yeah, please go ahead.
Okay. By the way, this is great question. However, we need to first of all clarify what is ideal point difference. Ideal point difference is basically computed based on UN voting, meaning that how consistently in United Nations you vote along with these Western countries. It's about values. And as you can imagine, sometimes non-democratic countries also can vote in alliance with United States, etc. So this ideal point difference is not specifically democratic versus non-democratic. It is calculated by political scientists, and it is basically about voting patterns in United Nations. And based on that voting patterns, they come up with this kind of a measure about how your values is aligned with those of Western countries. So that's very important thing to keep in mind. And of course, second important thing is to keep in mind that when we talk about statistical relationship, we're looking at average, right? So you can find like an example of, as you mentioned, some countries which may never vote with United States in or United Nations or be in disagreement, but still attract more foreign investment, like you mentioned about China. But what we are saying that on average, what you are seeing is that there is a strong correlation between voting consistently with G7 countries and attracting more foreign capital. And we empirically find this correlation to be strong, so that we consider this could be possible instrument. Of course, every instrument you can devise, they have their own problems, and we will just mention about deficiencies. But that's, I think that that may clarify some of your question. So
thank you so much. And Richard has already posted a comment in affirmative mode saying exactly. So thanks, Richard. Ali, did you want to add to this?
Maybe just in terms of no matter China or India, so as long as a country has a better relationship with the G7 countries, they are exposure to more international capital inflows, and therefore the firms in such countries have better access to external finance to import capital goods.
Thank you so much. And let me take this opportunity also to acknowledge the presence of a number of our colleagues, including Dr. Andrew Mwaba, previous of the African Development Bank. Thank you, Andrew, for being able to join us. Aweng Garang, and also Chuk Mak, leading scholar at the University of Birmingham. Innocent Agume from Kabbalah University. This is a large international group, I should mention. Our own a team here at the Center for Global Finance, Professor Sulai Tumine from Makere University Business School. You are all welcome, and the colleagues Tolu and others in the Center for Global Finance. So let's say continue the discussion. I'll call upon more hands to ask questions or intervene, but before you do so, let me share with you one question that is just become at the back of my mind. Is about the threshold dynamics. This is some of the threshold dynamics is when you have a momentum and then all of a sudden it changes and you are trying to pinpoint exactly when did it change? When did it change? Okay, in this case, one would argue that it is possible that an increase in capital inflows will increase imported capital goods, but maybe up to a point. Maybe as the capital inflows increase, maybe there is a reversal, trying to show that maybe there is a kind of U-curve or inverted U-curve in this phenomenon, okay? That happens in some series. We don't know what it does. I'm just being speculative and say, in terms of threshold dynamics, is this a linear relationship or could it be non-linear? That as if you increase tremendously, increase very rapidly, then come to inflows, could it reach a point that some of these capital flows don't translate into capital into imported capital goods, and therefore there might be a reversal? Maybe we don't know. It would need a linear threshold, a non-linear threshold modeling, a procedure to unlock that. And maybe I'm just talking about the next paper that I should write with the Tomoe and the group. Maybe, yeah.
Oh, thank you, Victor. And I think we can take into account this comment by, for example, introducing a new variable, which is capital flow square, and then multiply by external financial dependence and see whether there is a threshold or not.
Excellent, excellent. Thank you very much. So let me now go to the hands which are up. I can see the hand of, I saw a couple of hands, but now there is only Jeffrey. Jeffrey Gidosa is a researcher in Center for Global Finance, who is defending his PhD thesis very soon in a couple of weeks. Jeffrey, please go ahead.
Thank you, Victor, and thank you, Tomoe, for the presentation. Very interesting. My comment is like continuation of what Victor was saying earlier about your interpretation of the interaction term. Because what I wanted to know if there's a reason you remove the base variables of those interaction terms, the EFD and the CF, because if you add those base variables, you may end up having a different result in terms of you realize the net effect of that interaction term by the time you add both results or subtract both results, you may have a different positive to negative, because and also the numbers in parentheses, I'm not sure if they are errors. If they are, that may also explain why they are high, because these base variables act as control. So I'm thinking if you try to have a different run of this test and see if you have a different result with the net effect of the whole interaction, it might change from negative to positive. Thank you.
Yeah,
Thank you.
Tommy, I think you must go back to the baseline table and the comment we take into account in that table where we presented, actually we presented different sets of fixed effects and we didn't present those main variables because of the space, but we took that comment into account. So you can bring the table 3, I think, back and point.
Oh, thanks very much for that, Ali. Let me see. Do we have another hand? This one, Jeffrey, I think is the old hand, or do you want to come back?
No, it's an old one, sorry.
It's an old hand. Okay. Let me see whether I have any comments from the floor. Let me also check whether I have any comments from the chat. I should also add that meantime we are having this seminar, there is active social media communicating the discussion to the whole world, and those who follow any social media handles to see especially the results and what we're communicating. Have you got any feedback, Asina, from any of the social media handles you are looking at? Yeah, Asina, yes, go ahead.
Hi, Victor. I actually wanted to make a question, if that's okay.
Please go ahead. Yeah.
So my question refers to your robustness tests, and more precisely to the instrumental variable technique that you're using. So you said that the instrument variable is the countries, the distance of countries' policy position compared to the G7, if I'm not mistaken. How do you measure that, the policy position?
Okay, this is a measurement question.
Khosrow, can you please?
Okay. Thank you for your question. Actually, we haven't measured this one. This is a measure which is taken from political scientists, and we cite the paper in our work. However, the measure is based on UN data of United Nations. I'm sorry, United Nations data on countries' preferences along different issues. So in the United Nations, they discuss different issues and see how countries vote on those issues. For example, on human rights, on, for example, here nowadays, for example, on Ukraine, etc. And they just count how many times these countries voted along or in alliance with, for example, United States, etc. And they use this kind of data and come up with this measure. Thank you.
Excellent. Okay, thanks very much.
Very, very interesting. Thank you very much.
Excellent. Okay. Let me see whether there are any further comments, observation. But as usual, there always be communications and discussion outside this forum. And I guess that when Tomoe and her team are going to produce a revised version, again, that could be shared. But also, let me encourage participants to log into the Center for Global Finance, where they can still get access to this discussion. And if then they come up with any comment, they can send them directly to Tomoe and the group, or they can send them to Asina and Meng or myself, and then we can communicate with with Tomoe. In particular, this paper comes in at a very timely period, and it's likely to have a lot of policy take-up. And eventually, I guess, Tomoe, there will be an impact case study going into this for some of the countries. This is one of the paper that could be highly cited because of the impact it's likely to have. So I guess we try to keep in touch here. All it remains for me now is to, before I move a vote of thanks, maybe I should ask Tomoe and your team, Kushrev and Ali, if you want to say anything in the final before I close the meeting. So I give you the parting shots.
Thank you so much.
Thanks to all. Yeah, it is a very useful suggestion from Victor, and the questions as well very useful. As I said, we just about to finish, not quite finalized. So we will review our paper based on your feedback, some questions, and to finalize our draft. And surely your feedback would improve our paper to finalize, and then I'm sure we can submit to one of the journals. Yes, thank you all. Thank you to you all. Yeah, that's from me. Ali, anything?
Yes, I want to thank Tommy for her nice presentation, and thank to Victor and participants for their feedback. And I just want to thank you, Victor, again for pointing out the impact of COVID and the impact on imports of capital goods. And I want to add the new wave of nationalization and the conflicts among countries, how they may also affect the import of capital goods.
Okay, thank you so much. And there is a message in the chat from Richard. Yes, Richard, that's okay. Athena Omeng will share with you the required information very well, because part of the benefits of this meeting is networking. And basically, we build a fellowship with the outer participants, and therefore, it's good to network even after the end of this session. Yeah, that's brilliant. And perhaps before I conclude, I just wanted to share information with a paper I've been working on, relevant paper on this, which I've been working on with the colleagues Issof Somare and Francois Botiano, which generated very controversial results. And it was on capital flows. And we are trying to look at the impact of capital flows on productivity, taking total factor productivity and taking sample of African countries, a huge sample of African countries, almost all the African countries. And we are trying to see that maybe the effect, the anticipation that capital flows will increase total factor productivity is not always true. We argue that there are very heterogeneous effects. It depends on the destination sector. If it results into imported goods for manufacturing, maybe. What about if it is for construction? What about it for agriculture? And we find actually in some cases that the capital inflows may actually negatively impact total factor productivity. And we call it the capital allocation puzzle. That there is a puzzle. We should expect that there should be an increase in productivity for capital goods, but the fact that there isn't causes a puzzle. Now, this paper has been running for more than 2 years, because most of the journals says, no, these results are completely unexpected. No way. And this is true. So it reminds me of the paper by Paul Krugman, and others, a very important paper about the balance of payments crisis. But it is something, maybe a footnote, could be a footnote, that maybe sometimes the huge capital flows may not induce capital, may not induce growth, but still doesn't knock out the findings of this paper, because you don't finally go into growth. You have it in the theory, in the diagram of growth, but you actually don't estimate a growth model. So it's okay. You don't. The controversy we uncovered doesn't. But what is true in your paper is that the capital flows will increase the capital goods imports. In our paper, we were trying to look at that link between, is that going to have higher growth, getting out of capital flows, getting high imported goods? Is it going to have capital, a productivity? For Africa, maybe not. But that's the kind of different. Just wanted to just have a controversy, because this paper has caused us a lot of pain and has become controversial because we have a controversial effect. But let me take this opportunity once again to thank Tomoe, thank you, Ali.
Actually, Victor, you are right. At the beginning, as a introduction, I just there are some papers really talking about mixed evidence. The debate is going on the relationship capital inflows and capital whether they do reach the growth or it's still going on. So it's a kind of we are trying to one part. We are trying to just one part of the through the import of capital goods. So there are many scopes to go still yet to do research. That's what we think. Thank you.
Absolutely.
Yes, it's a good point. Yes. Yeah.
Absolutely. Your paper is safe. It hasn't gone into the growth trajectory, which is brilliant. And therefore, let me thank you so much for this interesting growth paper. You, Krishnav, Ali, and the other co-author, and I wish you the best. So let's give a hand of applause.